Are you there?
Got you, baby. I got you. How are you guys? Welcome to Everything Money Channel. You guys are incredible. I see all the chatter on the chat lines already. We go early to sort of drum up some attention a bit, get you guys talking. You can see Paul playing his chess. Paul, how far away are you from a grandmaster? Like, it's still decades, right? Like, you're. Like,
I'll never be a grandmaster. I have no desire to be. I mean, I have no desire to put the effort in to be a grandmaster. A master is, I mean, I'm hoping 5, 6, 7 years away. We'll see.
Give me a second, Paul. You're at least a little delayed. Can you see me, baby? I hear you.
I hear you. Do you hear me?
Yeah, you're just a little delayed. Give me a second. Shut down any extra tabs you have on your browser there, guys. We Paul and I have been podcasting all morning. We just did 3 episodes that are going to come out this week, and sure enough, as soon as we go live, we get a little delay on Paul. So if it continues, we'll keep rocking. But anyway, today we're going to go over today's focus is on our patrons out there. We have a Patreon page, patreon.com/everythingmoney. We started this a couple weeks ago, and it's a smashing success so far. You get access to our Paul's jumping out and jumping back in. You get access to our oh, here he comes. Here you go, Paul. Let me add you, baby. I hear you, baby. I hear you. Here you are. Can you see me now, babe? Can you hear me?
Yep. There's no delay now, right?
Yep, you're perfect. I love you. Yeah, so the Patreon's going incredibly well. It's in the link below in the description. If you join it, there's 3 separate levels. You'll get more exclusive access to Paul and I. December 10th, patrons, write this down. On the evening of December 10th, Paul and I will be going uncensored, unfiltered live from Paul's house, where we do a Patreon-only discussion. You ask direct questions to Paul and I to get your investment tips, strategies, and focus on what Paul is doing nowadays. So, but today we are using, Paul, I love this sheet. I printed this out a few weeks ago, and we use this all the time. This is what we analyze stocks with, guys. This is our 8-pillar analysis. And Paul, tell us how you came up with these 8 pillars for our new viewers. We have some new people on here. I see you on there, guys. I love you. Go ahead, Paul. Tell us about them.
So I want everybody to remember, first off, I'm going to plug, Brody's in the house. I'm going to plug our Patreon. Here's why. We get a lot of requests for different stocks to analyze using the 8 pillars live. What we decided to do is we will only take requests from Patreon users. Now in Patreon, there are 3 levels. All 3 levels, as long as you're a Patreon active user, will get the app for free. Exciting news, we're going to have a web version of the 8 pillars available here in the next 3 to 5 months. That is exciting. Everybody who is a Patreon member will get it for free. All you're doing is paying the 8 or the 25 or $100 level. $100 level people get all the access to me. They're the ones who can ask me specific questions, talk to me directly, etc. $25 level will get the fireside chats with us along with the $100 level. $8 level, you'll have everybody gets to talk to their own group. $8 level still gets the app for free when it comes out. But you guys are basically supporting us there, and you can make all the every level can make the requests for every single week's stocks that we go over. We're not doing it to be mean. We're just sitting there saying we're getting inundated with comments in every single post. We're getting inundated with requests. I would love to be able to do all of them, but unfortunately I cannot. So we're going to dedicate it to the Patreon users who are there. We're trying to build a Patreon. We currently have 34, 35 people. I think we're allowing many more, but guys, do it now. Join today. $8 a month, $25 a month, $100 a month. The people, Zach Dar is there on the $100 a month plan. He's awesome. He talks to us every single day. Mo and I in that $100 plan every month. You will see us every single day talking about our investment ideas. We've decided that we'll talk about all of our investments within that chat, so everybody sees how we think and how we talk. They ask us questions, we answer every day. So anyways, that's my plug. It's there to help pay for the app, as well as to give Don and Seth a raise once we get to our full capacity on the Patreon.
If you're new to our page, we welcome you. I see some new names. We're certainly glad to have you. Paul, I think we oversold the Patreon. I want to show people what they're exactly going to get and sort of your specialty. If you're watching other YouTubers analyze stocks and they're in their basement, and they don't look like they have a ton of money, or maybe not that successful, you might be wondering, why am I watching them? You are watching Paul, a 20-year stock investor veteran, owner of multiple businesses.
Longer than 20 years.
And almost 1,000 proper units of real estate, and he will be in Las Vegas tomorrow, and we will be broadcasting from Paul's Mexico mansion in January with Trader Mo. It should be quite exciting. So Paul is the real deal, and we'll welcome you in. Paul, let's get after it. Oh, Seth's a bit quieter there. Let me do this, guys. Let's talk about this. How's this feeling? I feel good now. Thanks, Llewellyn, for telling me, baby. I hear you. All right, guys, here we go. Paul, why don't we jump right into, these are off the Patreon request lines, and Phoenix, one of our patrons, we love you, Phoenix. He, people have been asking about this, Paul. This SFM. What is this, Paul? Let's look at it.
SFM?
Yes.
Sprouts
Phoenix
Farmers Market.
Okay. Oh, yeah. Sprouts Farmers Market. Now, folks, here's what we're going to do. Paul has used his 8-pillar analysis to analyze the health of a company, whether it's, Paul, describe the 8 pillars, how you got to them, why you use them, and what we're going to find out when we're done with them for each company.
Well, basically, Seth, you asked me one day, Paul, what do you do to look at a stock? And I said, well, here are the things I look at. It ended up being 8 things. And you said you came up with the 8 pillars. That's fine. We'll go with that. 8 pillars. And this isn't something that I just created out of nowhere. It's just something that I always, as you do investing, guys, you're going to find the things that you gravitate towards that make sense to you. These happen to be the things that I didn't even know there were 8 things until Seth said to me, what do you look at? And I was like, well, I look at this, and this when I first look at a stock. And that's what it was. I've just always gravitated towards these are the most important things that make sense to me when analyzing a company. So we basically called it that. That was all it is. And now I created an Excel sheet that shows me what companies get what pillars. And we're going to put that in the app so that you can get the app, type in a company ticker symbol, and it'll tell you which pillars are a check mark and which ones are an X. Boom. Now, this is not a reason to buy or sell. It's kind of a way of weeding things out. I've bought stocks that have 2 or 3 check marks. I've not bought stocks that have all 8 check marks, because there's not just, as much as investing is about numbers, it's also about the qualitative aspects. What's the story behind the company? Things like that we have to understand. So that's what we do on every single stock analysis. And that's it. By the way, today I did a lot of selling of puts, covered calls on a lot of my positions. If you're part of the $100 Patreon, you'll get access to what I'm doing at all times. Even the $25 one we'll get at the end of the week, etc.
Paul, this Cillian is asking a great question. Are you finally admitting that I indeed came up with the term pillar?
Yes, I will give it to him, even though Seth's argument for it is, Paul, I once used the word pillar in an email 18 years ago. If that's what it is, it's fine. By the way, it does sound familiar that Seth said pillars. Now that I think about it, I was like, maybe that does sound right. So we're going to give him that one. And I'm still going to own all the rights to it, though, since it's my show.
That's true. That is true, Paul. Let's jump into the 8 pillars for our first company, which is Sprouts Farmers. Go ahead, Paul. What is the market cap?
So the market cap, guys, is $2.5 billion. So it's a smaller company. That means if you wanted to buy all the shares of the company right now and own the company completely, you'd spend $2.5 billion. If you could do it right in here, right now, fully done.
Let me stop you real quick, Paul. You always say that, and even as a viewer myself, I don't quite understand. Why do you always say that's what you can buy it for? Why is that your mindset?
Well, because when you're buying a stock, you're buying a company. And even though you're buying a portion of the company, you want to look at it as if you're buying the entire company, because 10% of 100 is still $10, right? Which is, you might sit there, it's no different than owning 100% of 10. That's the way I look at it. It doesn't matter to me that's the way all investors should look at it. You're buying a piece of a company, but theoretically you're buying the entire company. Just because it's a piece of it doesn't make it any more valuable or less valuable, theoretically. Okay, let's get after it, Paul. Pillar number 1 is PE ratio. We want this less than 20. Well, we got one here, a check mark here at 9.9. So we are a check mark here on the PE ratio. Pillar number 2 is profit margin over the past 5 years. Profit margin. Now, this is small. It's 4%. Grocery stores tend to have lower profit margins and tend to have, we'll get into it, but they tend to have lower profit margin. The gross margin here ain't bad, 37%. I don't know how that compares to other grocery stores. That's pretty decent. What that means is for every dollar they add in revenue, they're going to profit 37 cents on that dollar. But at the end of the day, the bottom line in the last year has been 3.8%. Paul, scroll up real quick just to make sure, give everyone a name what we're doing. And this is Sprouts Farmer. This is scroll up. This is a Colorado a consumer store, right? Yeah, grocery store? Grocery store. Okay, let's keep going. How about revenue growth? Pillar number 3 is revenue growth over the past 5 years, Paul. So we're going to go to the financial statements and the income statement. And again, guys, the Everything Money app and website will have it all laid out like this. We're going to mimic this look. That way it's easy for you guys to understand. And once the website is available, I will be using our website to do this. So revenue growth the last 5 years, 3.6, 4.04, 4.7, 5.2, 5.6. So definitely a check mark there for revenue growth. Exactly.
How about profit growth? Pillar number 4.
Here's the net income: 129, 125, 158, 158, 150. Check mark there. It is growing.
Okay, how about number of shares? Pillar number 5 is the number of shares outstanding. We want this number going down.
The reason we want this number going down is we're going to own now the same number of shares, but a higher percentage of the number of shares outstanding. Therefore, we own more of the company just by buying our shares. 153 million down to 120. So basically, you own 20% more shares now than you did, 20% more of the company than you did before just by owning a share. So, as example, owning 1 million shares 5 years ago today is like owning 1.2 million shares back then. So it's a positive sign. We take their cash flow and buy shares back.
Let's do pillar number 6 is current assets greater than current liabilities. Paul, I always mess up and say assets over liabilities. So why is it so important that it's current?
So current meaning the cash on hand. It's not really cash on hand. There are things like inventory, but it's things that can be readily changed, can be quickly changed into cash. Okay. We want to make sure they can pay their current liabilities, which is basically the bills on hand that are going to be due very soon. So they have 438 million in essentially cash on hand, and they have 510 million in current liabilities. That's an X. Grocery stores tend to be this way because they buy a lot on accounts. They have a lot of inventory, et cetera. So they tend to be negative on the current assets and current liabilities. So even though it's an X, it's not worrying me as much as it would before.
How about how about free cash flow? The granddaddy of them all, free cash flow growth over the past 5 years average.
Okay, so free cash flow, guys, is cash from operations less, or adding in the negative capital expenditures, or subtracting out the absolute value of capital expenditures. What this shows us is how much money is left over for the company to do acquisitions, grow the company more, pay out dividends, buy back shares, things like that. We want to see. A lot of people only look at free cash flow. I like free cash flow a lot because it shows the actual cash left at the end of the day after paying for the capital expenditures being what's invested back in the business to keep the business going. So in the last 5 years, Seth, you have your calculator out?
I'm ready. Here we go.
Call it 210. Call it 70. I'm sorry. Call it 110. 70. 110. 120 and 170.
Tell people what those numbers just were.
That is the free cash flow in terms of millions of dollars every single year for the last 5 years. So what we want to do is we want to take the average of them, because taking 1 year can be a little misleading. We want to take the last 5 years. Now, if there's a lot of growth in it, we have to decide what number we multiply by to get a value. The more growth there is, we want to multiply by a higher number, because the recent number is going to be the recent number being skewed by the past numbers being very low. So not to get in the math of it, but the bigger the growth number, the higher the multiple, because it shows growth. We want to pay more for higher growing companies. So what's the average?
Well, I embarrassingly did it wrong. It's my stupid calculator, but I think it's around 90 something, 90.
Can I do it real quick without worrying about it?
Sure, go ahead. Go ahead.
You want to talk to everybody about how I do that?
Yeah, guys, while we're here, while Paul's doing this, as always, make sure you guys are smashing the like button. We really appreciate it. Paul's 70 watching right now. This is amazing. Guys, if I could just go back in time, we had 87 subscribers at the beginning of this year. Paul and I just felt like we were doing this show for ourselves. And sure enough, you guys have came out, represented us. Our subscriber list is growing every single day. We welcome all our new people, and it's because of you, your likes, and your support that we've done. We've just Paul and I have had a really transformative year. Paul has stopped being the CEO of Crossroads Holding Group and is now fully focusing on projects like this. And you guys are just really touching us. It's just amazing. My whole family knows about this podcast. My son, Gio Kirchanen, is on it right now. YouTube channel. My son is on right now, and he just put, Paul, that he got all A's, and he wants to invest in CVS, so he's looking forward to your analysis of CVS today. But let's go back to Sprouts Farmers. Go ahead, Paul.
Okay, so the average was 117 million over the last 5 years. So it was higher than you thought. So 117 million, we multiply by 20, is a little over 2.3 billion. So we're not far off. Now, this is part of the start. I want to know, one of the things I want to know in this company is they're a new company. They were founded in 2002. So I want to see how much of their growth is organic growth, meaning same store growth. How much of the growth is coming from stores that have been around for over a year, and how much of their growth is because they're opening more locations. A lot of companies, in order to be Wall Street darlings, will open a lot of locations. Here's a little tidbit. Borders Bookstore, it went bankrupt 10, 15, I don't know how many years ago. Their original business plan was for like 240 stores, and that was it. But once they go public, people want to see growth. How do you see growth? You see faster growth by opening more locations. It ended up not working for them. They went bankrupt. So this company isn't selling for a ton more than it should. It might even be a buy based on the growth potential. But some of the things you want to look at is how much of their growth is coming from new stores versus organic growth. How much of their other stores growing in new store, in current store sales, existing store sales as time goes on. I like this. I want to see how, I mean, what is their freshly delivered products naturally? So that's a very big thing now. Is it getting more and more fresh products? Guys, this country is becoming healthier and healthier. Companies like this are going to become better and better. It's also in hippie areas like California and Colorado, I'm sure. So they only have 340 stores right now. That's 7 per state, not even. I mean, this could be a very fast-growing chain that grows astronomically. By the way, most grocery stores have a bottom line profit of 1 to 2%. This is 3.8%, not bad. So, guys, I'm not exactly opposed to this one.
Paul, do you want to pull up the momentum chart here?
Yeah, we'll pull up the momentum. It doesn't look like the momentum's going well, though, but we'll see what it's looking like right now. So, guys, remember, just recently crossed 200-day. We want to look at it crossing over the 300-day moving average. It happened here at $23 a share. So if you bought it then, you'd be in the negative right now. But the whole point is, over time, if you bought a handful of stocks when the 200-day goes over the 300-day and sold when it goes below, you'd beat the market by about 1.2% a year. So that's based on a 20-year back test of 75 stocks in the S&P that had been around for a long time.
So what's your take home, Paul, on this stock?
I think this is a stock to watch. Go do more research in terms of what their growth plan is, how their existing stores are doing, how did they do during the downturn. Natural stores tend to be more expensive. So in an economic downturn, there might be more people pulling away from them and going for more value plays in terms of groceries. So take a look at it. I'm not opposed to this one. This one looks pretty solid from a fundamental standpoint from the numbers. Now you got to look at the story behind it.
That was off the request line, our Patreon request line. Phoenix, we love you. Thanks for being one of our patrons. Paul, another patron who's on right now, David S. Pumpkins, David Spicer, long shot. He's looking at Compass Minerals International, Paul, a CMP. Now, this is hilarious, Paul. I just realized, Paul, we do such... I really like that our patrons are asking for such boring companies that no one knows about, because all the other channels are somehow analyzing the projections for Nikola, and Tesla. And sure enough, our disciplined patrons are asking for companies that I've never heard of, and I'm excited to hear about them because we have analyzed companies off the request lines, and both Paul and I have immediately started investing and looking at their financials. And so, Paul, let's do another one. This is Compass Minerals International, Paul. What do you think about this thing? Thank you, David, for this.
Okay, so Compass Minerals International, based out of Kansas, $2.1 billion market cap, another small one. I like it. They produce two primary products, salt and sulfate of potash, a specialty fertilizer. The company's main assets include rock salt mines in Ontario, Louisiana, United Kingdom. All right, so they make salt. What's sulfate of potash? What is that, Seth? You're the chemist.
Well, I don't know what potash is. Obviously, sulfate is just like an SO2 group. It's not. I would say fertilizer is usually in there, but okay, here we go. Paul, let's do PE ratio. What is the market cap? You already did market cap. PE ratio.
2.1 billion. The PE ratio is a little high, 26. So
not terrible though.
Fair.
Okay.
Not awful. We have to see how much growth potential. Profit margin though, negative 0.74. So the last quarter they lost 0.74%, but in the last year, let's look at the last year. Their profit margin is about 6%. So still an X, but it's positive. Gross margin is only 21%. So they manufacture something and the gross margin is only 21%. That's a little concerning to me. To manufacture something, usually manufacturers have very good margin, but to have a 21% margin after manufacturing, that's a little bit of a red flag. Keep in mind, high dividend here, 4.6%. That means every year they're spending about $92 million per year on their dividends. So what we want to make sure is their free cash flow can easily support that. We don't want to see just 90 million in free cash flow every year. We want to see significantly higher than that. They don't have to pull it back if things get a little tight. So far we have 2 X's overall on the company.
How about pillar number 3 is revenue growth over the past 5 years, Paul?
All right, so some solid revenue growth, $1.1 billion, $1.140 billion, $1.360 billion, $1.5 billion, $1.5 billion. So there's definitely a check mark there.
How about profit growth? Pillar number 4, Paul.
All right, 159, 162, 43, 69, 63. X right there. And going back, it looks like their profit's very inconsistent. So this is especially important to take a 5-year average of their profit and look at that. So they might not be, I don't understand. This is a very immediate red flag. Why did their profit just plummet from 9 figures to 8 figures consistently? We have to figure out why that is. Let's go to the trailing 12 months. The last 12 months, they've made 83 million. So this is kind of a question. Maybe there's a reason for it. Maybe they had some restructuring. Maybe they figured out another way to make money. Their revenue is up 50%, but their profit's down. So look at that. The revenue went from $1.1 billion to $1.5 billion, up 40%, and their profit's down from 160 to 60. Down, 60%. That's a lot. So this is a kind of a red flag about it. We have to look at that.
How about pillar number 5 is number of shares outstanding, Paul?
This is an X, but barely. 33.68 to 33.88. So it is an X, barely, but they are going up every single year in terms of number of shares outstanding. A lot of X's here, but this might be an example of one that has a lot of X's that we're not necessarily saying no to.
Paul, I love you guys and gals in the comments. They're not people are arguing about what we should do next, Paul. So it's a great problem to have. We appreciate you guys out there. I'm going through the comments.
If you guys want us to do stocks, you got to come into the Patreon, make your requests.
That is true. So I have a list of our patrons, what they ask for, and so which we will go over with them in our Discord channel, which you'll get access to. So it's a cheap plug. But Paul, keep going. Let's go to pillar number 6. Is current assets greater than current liabilities for this company?
I want to thank someone. Did we just get another? I think we got another patron.
I'll be darned, Paul.
I don't see. It says 35, but it's not posting who it was.
Well, thanks for joining, guys.
I think somebody bought the $100 package just now.
I'll be darned.
That's great. Thank you very much. You'll get a lot of access to us. So current assets versus current liabilities: 685 million versus 301 million. So they have plenty on hand to pay their current bills.
What about total liabilities, Paul?
So total liabilities is 1.8 billion.
Wow.
So they don't have enough to pay that off. It's a lot, but we don't know if it's a lot. What's that debt comprised of? I have no idea. They have $1.5 billion in revenue and 1.8 billion in liabilities. Doesn't seem like a ton. These are the things you have to look at as ratios and understanding that. I don't know if these in and of itself will not tell me if it's good or bad. It's about talking about the industry, understanding the 10K.
Paul, our new patron's name is Jacob. We welcome you, Jacob. We appreciate it. We're gonna be great friends from here on out, my friend. I can't wait. Paul, let's keep going. The granddaddy of them all, pillar number 7, is free cash flow growth over the past 5 years. And I won't screw up the calculation this time, buddy.
Guys, let's have people sign up for the Patreon. Go on right now and sign up. Don't be cheap. All right, so the free cash flow. I'm serious. Everybody wants access. I will give you all anybody in the $100 chat will tell you I'm in there every single hour, every single day talking. So is Mo. All right, so free cash flow.
Go ahead, Paul.
Are you going to do this right this time?
I'm going to do it right, baby. You got me.
All right, ready?
Yeah.
-80.
What? Okay.
-15. 37.
I screwed it up, Paul. -80 minus 15, then 50.
No, then 37 plus 37.
Jesus. Okay.
Plus 90.
Okay.
Plus 60.
Plus 60. Okay, that's 92 total divided by 5 is 18.
Guys, this is a tough one for me. The free cash flow is bad. It's decreasing. It's increasing because it went from negative. So there's a check mark there, but the multiple is a big X. They had plenty of free cash flow in the first half of the decade, and then it plummeted. And now it's rebounding again. You need to understand what's going on here. I don't know how they're generating their cash flow. I'm not saying yes or no to this one. You got to do a lot more research. If you like the idea of the company, then go for it in terms of doing more research. But this is not one that makes me scream yes, and it's not one that makes me go no. If I were leaning anywhere, I'd be more no than yes. I think there's probably better opportunities out there in other companies because the free cash flow is just garbage, averaging 19 a year. Even at last year's, what was last year's, like 80? Even last year's 80, 20 times that is $1.6 billion. It's still overpriced. So I'm still not a buyer, even based on 1 year's cash flow. But again, this one has such inconsistent cash flow. You don't want to take 1 year and just deal with it.
Paul, I'll flash this up on the screen. Zuri, welcome. Thanks for watching. I would say if you're interested in NEO, it's bad through the fundamental analysis with Paul. We've done a couple NEO videos, and it's astonishingly terrible for a disciplined investor. For a flashy trader, yeah, certainly it's exciting, trending stock, but Paul is nowhere near touching NEO. In fact, it's laughable. So, Paul, I think the next one off the request line. Before I get to it, guys, make sure you're smashing that like. We love you. We see you. And again, congrats to your new Patreon. I think it's really going to change, Jacob. It's really going to change your life. If you had talked to me 4 years ago before I met Paul, I knew very little about any of this stuff. And getting this guy in my life, literally in my children's life, has really changed my mindset. And he's assured me I'm going to be able to retire and with millions and millions of dollars, right, Paul? I mean, I was so worried.
As long as you follow the right steps and don't buy your NEOs all the time.
Yeah. So I can't thank you enough for joining us. We're going to be great friends. And make sure you book your calendars December 10th in the evening. You'll have an unfiltered, uncensored Paul and Seth. We'll be dropping so many F-bombs, Paul. It'll be amazing. Paul, Nick, our wonderful patron, wanted to do Citrix. This is an interesting company, CTX.
Is this Nick Korchinski?
Is this Nick? Oh, I thought it was Nick Lamore, but maybe I'm wrong. Maybe this is Nicholas.
It could be Nick. That's possible. He's our he's our Dynasty owner rep. Awesome guy. Does a great job.
Great. Yeah, let's do Citrix, Paul.
How do you spell? What's the ticker on that one?
CTXS.
There we go. Citrix Systems.
Paul, right off the bat, for everyone who's new, like most people say, oh, is White Chart stalling out? There we go. For people who's new, and for myself for the past decade, why do you not just look right at the stock price? Why is that not why you're not interested in that?
Well, because the stock price just tells me what the market perceives the number to be. The stock price can be manipulated by number of shares outstanding. If you have a company that's worth 1,000, if you have two companies worth $1,000, one of them has 100 shares, one of them has 1,000 shares. They're both still worth $1,000. To buy the whole company still takes $1,000. One's $10 a share, one's 100. Some people would say it's 10 times more. It's not. It's the same value. They're both worth $1,000. The market caps are $1,000. That's it. I want to bring up Citrix though. So we keep talking a lot about NEO and bubbles. This is Citrix's stock in the tech boom. Went from $1.60 to $94, $95, and then back down to $4.80. Does this look familiar, guys? This run up? It looks exactly like every bubble we see. And I'm just going to show that companies will fall by 90% and still stick around because the company is still around today. So before you buy into the hype, just look at this massive run up and then this massive collapse. And then since then, it's just climbed back up based on fundamentals. Okay. That's what matters here is fundamentals. It's beaten the high, but look how long it took to get over 90 again. It took freaking 17 years to get back up there. 17 years. Companies can still stick around and still do well, and their stock price plummets. That's the whole point I'm trying to get at here. You guys are learning that from talking with us.
Paul, will you address John Hayden, a great follow of ours? I love you, John. He said, "Will you tell people who Trader stock? Oh my God, Paul, I almost who Trader Mo is? Who is our friend Trader Mo?"
Trader Mo is a friend of mine, lives down the street from me. He's been a friend of the family's actually his father and my father have known each other for decades. We never knew this. My brother became friends with Mo years ago. I didn't really become friends with him until about 19 months ago when he moved in my neighborhood. Now we're very close friends. He works in our office. He doesn't work for us, but he rents an office from us. He helps with investing. We bounce ideas off each other. He's very active. He's more of a day trader than I am. So we're going to start building up some of his. We're going to start doing some videos for him on trading and chart reading as we build up this channel. And once we get over 10,000 subscribers, we'll probably start doing that a little bit more.
Yeah, we will be broadcasting in January, the first of the year, the first week in January. We will be broadcasting from Paul's Mexico mansion on the cliffs of the Pacific. The three of us, Paul, myself, and Trader Mo will be there. So stay tuned for that super flex. I know, and Trader Mo just said if I call him Stock Mo, we won't be speaking again, which is true. Stock Mo is an imbecilic educator on YouTube. Check him out. It's laughable. But Paul, let's get to what the hell company are we doing right now, Paul? I totally forgot.
We're doing Citrix Systems.
Citrix, go. What's the market cap on this puppy?
So $15 billion. So the company is worth $15 billion if you buy it all out right now. PE ratio 27. Not terribly insane, but high, especially with this big run up in the stock. There's probably some room there to show that it can drop, but 27 is an X. Profit margin. So this is surprising. The profit margin is only 13%, and their gross profit margin is 84%. I'm kind of surprised to see this low profit margin bottom line. It's still a check mark, but for software companies, you'd think a higher software companies like Microsoft and all these other ones have very big profit margins, like 30-40% to the bottom line, but the gross margin is very good. That means for every dollar they add in revenue, they're going to make 83 cents in profit. Pay a very small dividend, about $150 million a year, $160 million a year, nothing major. So
how about pillar number?
We have one check and one X.
How about pillar number? Paul, can you square up on that camera so I can see a baby in that circle there? There you go. You look so lovely. How about pillar number 3 is revenue growth over the past 5 years, Paul? Pillar number 3. Love you guys watching, by the way. Love you guys.
2.65, 2.76, 2.833. Very slow growth. Check mark, but very, very slow growth.
How about
Let's see how they've done during the downturn.
Okay.
They actually have revenue growth. They actually have revenue growth in the last year, pretty substantial. So that's good. So they are growing a little bit more, but profit growth.
Profit growth is pillar number 4.
All right. 319, 536, loss of 20. I guarantee there's some sort of write-off here. 575, 681, massive check mark. I like these numbers. These are nice and steady growth.
Nice. How about pillar number 5 is number of shares outstanding?
And by the way, I want to make note to everybody. Look at me. I'm ignoring the minus 20 million. It doesn't even bother me. I want to understand what that is to understand, but if you look at the last history, the last 10 years, there aren't any other random negative numbers. This is definitely a write-off of some sort is my guess. So I'm okay with that.
Pillar number 5 is number of shares outstanding, Paul.
Look at this, 159 million down to 130. So these guys are taking their free cash flow and buying shares back. So another check mark there.
How about pillar number 6 is current assets greater than current liabilities, Paul?
Software companies tend to be very good about this. 1.7 billion in current assets, current cash on hand. An X here, guys. That's kind of surprising, but over history, it looks like they have this X a lot. So you have to understand why that is. Like, I don't see in the last 10 quarters when they've had more current assets than current liabilities. That's kind of interesting. So X there, kind of surprising for a software business. So I'd want to go understand why that is for this company.
Paul, pillar number 6, current assets greater than current. Did we just do that one, Paul? Sorry, I'm trying.
Yeah,
I'm sorry. My favorite one is free cash flow growth is pillar number 7. Free cash flow growth is cash from operations minus capital expenditures. All pay attention to this one. Paul loves this one.
Okay, so free cash flow, guys. This is where this is where the company, oh, look at this. Guys, look at this. They barely, software companies don't have a lot of capital expenditures. That's investment back in their fixed assets, because what fixed assets do they have, really? Not many. So, Seth, you ready?
Oh, God, I'm going to screw this up again. Go ahead, Paul.
I'll do it.
No, I'm doing it. Just yell them out. Just yell them out. Go ahead. I got you. Right here, baby.
Okay, ready? 930 million, 1 billion.
Oh, boy.
Just do thousands.
I got it. I'm doing 1,000. Go.
820.
820.
950.
950.
710.
710.
So this is an X. It's decreasing. This is an X on the free cash flow growth. They are decreasing their free cash flow. What do you have as an average, Uncle Seth?
880.
880 multiplied by 20. 17.6.
Yeah, 17. Did you do that in your head?
Yeah.
Oh my God. 17.6. Okay.
It's actually a check mark here, guys. From a free cash flow perspective, it's selling for under 20 times. And but the one thing I want to say is they had a drop in free cash flow last year, but it looks like from the previous 12 months, it's actually up in the last 12 months. In the last 12 months, their free cash flow is at a little under $1 billion. So this might be a buy. Who suggested this one? Nick?
Who was this? What are we doing? Oh, no, this was,
Nick Larimore.
Oh, this was Nick. Yeah, this is Nick, one of our patrons.
Yeah, and one of the guys who works for Dynasty Owner. Oh, Nick, this is a pretty good one. What do you know about them? We should, it'd be interesting to find out more about this company. They can easily afford their dividend by 5 times over. This is, Trader Mo, you might want to add this to our list to look at. The only thing I don't like about it, that profit margin, I'm not a huge fan of, and the free cash flow dropping over the last few years, but rebounding now. We understand why that is.
Paul, I want to address something. Paul, I want to address something. Guys, okay. I see 75 of you watching right now, and, I criticize my wife sometimes, Paul, because she throws around the word I love you a lot. Like literally, we'll be at dinner and someone will like give us bread, and she's like, "Oh my God, I love you." And I wholeheartedly want to take a step back from all the numbers and the BS to say how much we really can't thank you guys enough. This show represents so much of Paul and I's life. I mean, we both obviously have other careers, and I just find this guy so interesting. And so the fact that like you as new
another patron.
Yeah, I see all these beautiful names, these new names coming through, guys. And it really fills us with a lot of positive energy in a really crappy year. It's great to have you guys. Paul, you mentioned before that you work a lot on yourself and really being happy. And we have had sit down, long, multi-hour conversations about happiness and what money does for it. I ask you, like, dear God, like what is it like to have so much money to be able to do whatever the hell you want? And you still struggle sometimes with happiness and friendships. And so like, it's just so nice to have this new community following us, Paul. And the fact that we get to speak to you twice a week, it's been incredible. Paul, talk about that idea with all these numbers and BS. Like what are you trying to do in life? Sum it up here in a minute.
I love teaching. That's why we have this YouTube channel. That's why I'm getting a job at a local university to teach the law students finance. I just do whatever I want. I've realized more and more, so the idea, this is what I always tell people. 15 years ago, guys, and I'm not exaggerating about this at all. 15 years ago, the idea of me not being the richest man in the world was devastating. The thought of me not being able to become the richest man ever would have been like an awful thought. Like that was my goal, full focus. Even being number 100 would have been devastating. Now, as I started making more money and having more, I started to realize, wait, but my happiness isn't going up by several amount. And now one of the guys watching the show is named Mason. He's in a group chat, and they call this guy New Paul. This New Paul has been going on for about 8 or 9 years now, where it's been a gradual process. I want everybody to realize that investing for me is a lot of fun. I just like doing it, and I like teaching it. I like these engagement. We have 80 people watching right now. At the end of the show, there'll probably be 350 total that have been on the show. We're getting used every day. It makes me satisfied to see the interactions and us helping people, the people who join Patreon and learn. I just like doing that. I'm going to have plenty. I'm going to be able to do what I want. I'm going to achieve every financial goal I have. So my whole point now has been, so what's the purpose of doing the things I don't like doing just to go make a few extra bucks? I already spend whatever I need to spend. I just already lived the life I want to live, and take it from a guy who has money. The money is going to provide ease in life, which can provide happiness, but fundamentally the happiness will occur by other things we do. And for me, teaching is a big part of it. Like, Paul, I don't care about the money even for the teaching. I want to make sure that we all I want to get compensated for it, of course. I want to make sure that I get compensated so I can compensate Don and Seth and invest more in the business. That's only because I have other overhead costs. I want to be able to do. I took away from my business, from my partners, to be able to do this. So I need to be able to pay them back by generating revenue for the business.
Paul, Caesar said, are we planning on doing more teaching? Absolutely, Caesar. This is what we're all about. Yeah. So the Discord channel, Paul basically teaches all day. We will have Patreon-only videos where Paul will analyze his portfolio, mine as well. In July of next year, I come around with my Paul. July is when I bought and sold my little book, To Beat the Market. So I have a separate stock investment strategy that we can discuss. But absolutely, Patreon is for all that uncensored videos that we're going to do. We're going on location. We're going to look at real estate, business growth. It's all in there. And it's going to be incredible. And Paul, I would say, it's funny, Paul. We're getting some suggestions, Paul, for like, for example, Scott's Miracle Grow, SBE. Is it safe to say, Paul, that if I pull up a stock, guys, I sort of like look at what you guys are asking for. So, Paul, if the stock is just going like straight up like a jet, is it almost safe to say you're probably, it's a no buy for you? I mean, is that like, is that cutting it too easy, or like, what do you think?
Listen, overall, I'd say that I'm going to avoid, if it's jumping up like a jet, it means that people love it. And the more people that love it, the harder it is for me to get on board. I was thinking, by the way, Seth? You know what we should do?
Go on.
We should have a Patreon portfolio where we create a portfolio that I invest in based on our Patreon's suggestions. Not a lot of money, but maybe I put X amount of dollars into it. And for all the Patreons, we sit there, and the patrons on Patreon, and we sit there and we have a voting system where we come up with a bunch of stocks and we vote which ones we're going to own. We're going to buy X on January 1, and we're going to reevaluate at the end of the year and see what we want to do. That would be, oh wait, David Spicer saying that was his idea.
Well, David thinks most of the ideas are his. I love you, David.
Maybe it was his. The whole point is like, that'd be a fun thing to do.
Yes,
and
Tesla,
I don't mind
yes.
doing that, and sitting there and saying, let's have a good time with it. So either way, we'll figure something out like that. And the other thing is, I want to make sure that I'm adding more and more value to the Patreons and patrons out there. Our portfolio of democracy. That's great.
I would say that these early patrons, we really do love you guys. And when Paul is planning the weekend-long or week-long investing education seminars in his Mexico mansion, we will certainly have you guys on the short list for being there.
And we got another patron. So we've gotten 3 patrons since the show started. Whoever was the third one, thanks very much.
Paul, do you want to look? Do you want to look off the request line? Do you want to look at Scott's Miracle Grow with his
yeah? Because you know why I like Scott's Miracle Grow?
Go
it
on.
Doesn't sound sexy to me, but it's a brand name that we all know. So let's figure it out. Let's go look at it.
You know, this is very interesting to us. Scott's is based here in Marysville, Ohio. Paul, I drive past it a lot. Oh, I see. Oh, here we go, Scott's. Now, so Paul, I pulled this.
Marysville?
Oh, absolutely. Oh, yeah. Oh, absolutely. Huge.
I didn't
huge.
know that.
This supports a lot of rural Ohio towns. Scott's Miracle Grow. It's incredible. But let's start, Paul. Let's do the 8 pillars on this. What was the?
They're also the leading supplier of cannabis growing equipment in North America.
Oh,
so that's why there's a big surge here. I see this big surge here. I'm like, man, why is all of a sudden fertilizer such a big deal? That's why.
Elias is here from Sweden. It's amazing to have you guys overseas. Yeah, I love it, guys. Here we go. Paul, what is the market cap for Scott's Miracle Grow?
Let's call it 10 billion just to keep it easy. 9.8, we'll call it $10 billion. First pillar, PE less than 20. It's an X. It's at 26 right now. That's fine. We'll see. Maybe there's a growth story to it, but it is a little expensive. It's an X.
How about pillar number 2 is profit margin? We want that greater than 10%.
Okay, so here the last quarter was bad. So we're going to go to the last full year. It's about 9%, a little over 9%. So it's an X technically. Gross margin of 24%. Again, not that great, but they sell to the big stores, so they can't have as much margin. They sell to Home Depot, Lowe's, etc. So that's that. So 2 X's so far. That's fine. Dividend yield of about $140 million a year. They pay about $140 million right now in dividends. So we'll use that in the free cash flow to see if it's supported. So right now we have an X on PE and an X on profit margin.
Let's go to pillar number 3, revenue growth. Paul, why we pull that up? It was John Hayden that signed up for our Patreon. Welcome, John. You know, John, the way you commented over the past multiple weeks, I felt like you belonged talking with us on a daily basis, and we will now get that. I'm excited to befriend you and learn some of your strategies. We'll definitely learn from each other. Paul, let's look at the revenue growth pillar number 3 for Scott's Miracle Grow.
Whoa.
Come on.
2.5, 2.6, 2.7, 3.1, 4.1. So, yeah, I'm wondering how much this has to do with cannabis and how much of this has to do with, did they buy something? Did they start something internally? I don't know. Trailing 12 months, yeah, very consistent growth here. So they've had a lot of growth, is my guess, in the cannabis section. This is a definite check mark. This has a growth story to it, guys. And 25 for a growth company might not be a bad idea.
Paul, let's go to pillar number 4 is profit growth over the past 5 years.
It's a profit growth. 315, 218, 64, 460, 387. Not very consistent. Still a check mark from 315 to 387. The first 5 years of the decade was very consistent, mid 100s, and then it jumped up. So that's a good sign. We do see some revenue and profit growth there. Number of shares outstanding, 61 million down to 56 million. Check mark again. So we have some good check marks here on the financial statement.
Paul, we don't talk about politics often, but would you think that maybe Biden might open up some cannabis things? It looks like in the past election, a lot of states are switching to.
Yeah, cannabis was very popular during Trump's time. I mean, we're going to be this entire country is going to be free cannabis. It was going to be legalized cannabis at some point very soon. The rumblings were starting in the 90s, and it's just ridiculous that we have any laws on drugs. And let's go free everybody who's in prison for drug crimes. What up?
That's Paul's hot take on the prison system. Pillar number 6 is current assets greater than current liabilities. Paul, let's look at it.
Okay, so current assets 1.2 billion. That's current cash on hand, roughly, and then 950. So they have enough by $250 million. We're good there. Yep, so that's good.
How about pillar number 7 is free cash flow growth? Free cash flow growth.
Okay, so you ready, Seth?
Oh, shit. Okay, yeah, I'm ready.
I like this, by the way. A large percentage of their cash from operations goes to free cash flow. They have a low percentage of capital expenditures. Seth,
go ahead, Paul. I'm ready. Go ahead.
185, 290, 280, 180, and 600. No, sorry, 500. Hello?
Dead silence. 1435 is a total divided by 5. 1435 divided by 5. That's 287, Paul. What did I mess up? Does that seem right?
That sounds about right.
So free cash flow average is 287.
Multiply that by 20.
5,740.
So 5.7 billion.
Yeah, market cap is 10 billion.
Yep, so we need to drop. Now, there is a growth story here. So I'm willing to pay a premium. So one of the things you have to do in your analysis is say how much of this cannabis stuff is adding to their bottom line right now and how much will it in the future. This is a big growth industry. If I were going to bet on a cannabis business, it would not be one that's just brand new. It would be something like this that already has a great brand. Scott's Miracle-Gro. Everybody knows Scott's Miracle-Gro. Everybody does. So I like the fact that the leading manufacturer of the equipment. I like this. Am I saying buy it at 10? No. Am I saying buy it, wait for 5 point whatever? No. I think somewhere in the middle. And great news is it's been a high flyer for the last year. It's been low. It's got as low as $77 in March. Am I buying it at 77? Absolutely. Am I buying it probably at 125? Yeah, probably. So one of the things I'll tell Mo and I is we need to go research this company more and then look at puts for future dates at 125 or so, see if we can sell some puts in that range to be able to buy this company at a lot lower price. But great suggestion. Love the idea behind this. Still a lot of work to do, but I love the growth and the fact they're going into a very, very big industry.
Paul, do you want to look up the momentum on Scott's Miracle-Gro? I'm really drawn to this company.
Yeah, you're really drawn to this company.
Yeah.
All right. They crossed the 200-day, crossed the 300-day back in July of 19 at $100. If you'd bought back then, you'd be killing it right now. You would be killing it right now. You would be up 75% of your money in the last year and change. So again, the idea behind the momentum is we back tested going back 20 years on 75 companies that have been around for decades. When the 200-day goes above the 300-day, you buy. When it goes below, you sell. And it beat the market by about 1.2% before all taxes and fees.
Paul, let's look up if there's more questions out there. Keep them coming, guys. Phoenix, we're definitely going to go a little over today, I think. Paul, how long do you want to go? It's 1:46. I can't believe we've already been going 45 minutes. It's incredible. But
I know. Doesn't it go, I always tell. I told Seth every morning, every night before our live streams, I'm like, live stream tomorrow. Exciting stuff. I love it.
Paul, you got a little Trump dancing going on there. Kind of.
No, he does that.
Does he offset him? Yeah, that's you, bro. That is you, bro. For sure. People are asking about SBE, Paul. This is this charge company. Do you want to look at it? SBE stock?
Switchback Energy Acquisition Corp. Pass. Next.
Whoa. Why, Paul? Why?
No revenue. No effing revenue. Come on. What's going on here? It just went public. There's no revenue. Trailing 12 months, zero revenue. F off. No thanks.
Paul, how dare you? Now, people are asking about NEO because NEO's down 10% the last 2 days. Is now the time to jump in, Paul?
If you are mentally stupid.
Paul.
Okay. Guys, you know my view on NEO. If you want to do it on a trade, figure out a way to trade it. Fundamentally, I don't buy into it. That's just me. I'm not going to do it.
Yeah, I guess people are interested in SBE because it's Tesla associated. Paul, that's what people are saying. So,
hey, Nick, to answer your comment about Paul 2024, I was actually born in the Middle East, so I cannot run for president ever, and I would never want to run for president because it is.
You got too many. You got too many ghosts in your closet, Paul. I think. Yeah.
There'd be way too much bureaucracy. I couldn't deal with that.
Paul, let's do just a couple more. John was asking for Mesa Air. Do you want to look at that airline? Airlines obviously have been on our radar. And Dan, I see you there. We're going to do CVS next. So Phoenix, we definitely have a few more minutes. And Dan, I see you there. I love you. We will do CVS. Go ahead, Paul. Let's talk about Mesa Air. What do you think? Oh, look at this, Paul. This is interesting.
Yeah, the PE is low. The gross profit margin, so the other thing about the airlines, we did airlines and travel a lot. I still believe, I actually sold all my Love stock, if you guys remember. People who are in the Patreon and the Discord will know. My part of the concern, part of the risk of covered calls is they get called away from me. I wrote a covered call on my Love stock at 47, and they got called away from me. I no longer have Love stock, but I bought at 25, went to 47. I think they were worth 50 to 60. No problem releasing them. Move on, find another stock, or wait till they drop more to buy some up. So Mesa Air, I don't know why this gross profit margin quarterly. Let's see here. Financials. I just want to do a 500-foot view of Mesa Air.
Sure. I do like, again, Paul, I do like when I see a tanking stock. It gives us a chance. Obviously, this is the buy low, sell high mentality. So,
yeah. Quarterly.
Tell us what you're looking at.
I'm looking at the quarterly numbers. They still made money every quarter, even with the downturn. That's pretty interesting. You see this? First quarter, they made 2 million. Second quarter, they made 3.4, even with 167. Oh, that's pretty interesting, guys. Balance sheet, 112 million. That sucks. They don't have much. They have a lot of bills coming in, guys. Free cash flow. Bleh. Free cash flow is awful. Even stabilized, it's awful. Yeah, I'm going to pass on this one. They have no free cash flow, even during good years. That's a problem for me. Like, how are you going to pay investors? How am I an investor going to get? I do still own CCL, Richard. But how are you going to get money back if there's no free cash? Free cash flow is how an investor gets paid back their money, really, if the stock goes nowhere. That's something we talk about, is that as the stock goes nowhere, you got to get your money back by free cash flow building up, the cash position of the company building up, and somebody seeing that, and the company taking that cash and paying it out as dividends or buying back shares that increase your percentage of the profits. The per share values go up, all shares go up then. That's how you make money when the company's not growing a ton, but just generating a lot of cash flow. There is no cash flow here. There are other airlines to buy that are better.
Paul, let's finally look at Dan has been asking, he's been on since the get-go. We want to look at CVS. You have a young 10-year-old in the other room who's dying for some reason in love with CVS. Convince him whether he should be in love with this or not. That's my son Gio. He's on right now. Go ahead, Paul. CVS.
Gio. And look at CVS. It was $112 back in 2015. Now it's $68 a share, almost half. So it's a $90 billion company. Wow. PE is only 11, guys. So check mark there. Profit margin, not so good, guys. For the quarter, 1.8%. For the year, about 3%. This is pretty typical of these big box, massive stores. They're there for the volume game, not for the margin game. So they have a 3% dividend yield, which means they pay about $3 billion a year, $2.7 billion a year in dividends. So right now we have one check and one X.
Pillar number 3, Paul, is revenue growth over the past 5 years. Revenue growth
the last 5 years. 153, 178, 185, 195, 256. Definite check mark. That's a lot of growth. I think there was a healthcare acquisition somewhere along the way. They're going to diversify. Hopefully, somebody find that out. This is not internal, but this is not organic growth. I want to know how the same store sales have done year in and year out. Are they increasing, decreasing, etc.? CVS bought Aetna, so they have health insurance. It's pretty good. I like that.
Paul, we'll go
profit
back.
Growth.
Yeah, profit growth, pillar number 4. We will go back. Someone's saying not SBC, but charge point. Maybe we need to look at what that is, Paul. But anyway, keep going, Paul. This is profit growth for CVS.
5.2, 5.3, 6.6, random loss, 6.6. So check mark there.
How about pillar number 5, number of shares outstanding, Paul?
Ooh, 1.1 to 1.3. They probably issued shares in order to buy Aetna, is my guess. That's probably what they did.
Okay, how about pillar number 6, current assets greater than current liabilities, Paul?
I imagine it's not going to be good. 59 billion in current assets, 62 billion in current liabilities. It's a retail store that's low margin. They're not going to be able to cover that very easily.
Okay.
So that's there as well.
How about free cash flow? Pillar number 7, free cash flow growth. Cash from operations minus capital expenditures. Yes, Uncle Paul.
Okay, ready? 6.2, 7.9, 6.1, 6.8, 10.4. So it's a check mark on growth. What's the average, Uncle Seth?
7.5.
Wow. So they're selling for about 12 times, not even 11 times, 12 times free cash flow. Not bad. Not bad. Not bad. Now you have to make your assumptions. The issue we have here is the sheet that I use to determine what I want to pay for a stock. It goes based on revenue growth. The revenue growth here is big, as you remember, because of the Aetna acquisition. So we don't know. Now, the other thing, though, is there were years of free cash flow in which the Aetna acquisition wasn't accounted for. This actually might not be a bad play. We have Walgreens. We might be wanting to look at CVS. Trader Mo, we have to look at CVS a little bit and see how the Aetna. So the big thing here is how's Aetna going to help them generate more cash flow, bring people more into the store. I'm sure a big part of it has to do with bringing people to the store. When they're there, they're buying pop, they're buying chips, they're buying a small gift, they're buying candy, etc. They're getting their film developed.
Yep.
So either way, this isn't bad, guys. I'm not opposed to this. The free cash flow looks pretty solid. The question is it sustainable? The PE is low, and they can definitely easily afford the dividend, because the dividend was about 2.7 billion and their free cash flow was 7. So they can easily afford the dividend. It's a nice solid dividend, 3%. It's beating the market by over 1%. So I'm not opposed to this one. This is something to do more research on and get some more information on. This is good.
Paul, do you want to quickly contrast this with compare and contrast with Walgreens? WBA?
Yeah, we can do that. Can somebody please buy another Patreon at freaking $8? We get an app for free that will do this all for you for free instead of paying $25 a month when you realize how awesome it is. Thank you.
Now, Paul, tell us about the app. You wanted to spoil and tease an update.
I think I said it already. There'll be a web version available here in 4 or 5 months that is going to be free for every Patreon user as long as they're a Patreon member. And it's going to allow you to do the financial statements and the pillars, and we'll test it out. But it's going to be before the app, but it's going to be a web version. So you can be on the screen like this.
Yeah, Daniel's right, Paul. I think a lot of the free cash flow goes into printing those amazing receipts that you get from CVS. It's like people just walking.
I remember there was a meme once. There was a meme once that it said something like one CVS receipt can span to the moon and back or something like that. It was pretty funny.
Paul, let's do this. Make sure you guys are smashing the like button. It's great to see you all there. Paul, we've had consistently over 70 people watching. It's just quite incredible, folks. Going back, like I said, in January of this year, we had 87 subscribers. So you guys are doing great. And welcome to all the new folks, the new names. I can't even keep track of y'all. You guys are incredible. I did say y'all. Did you hear that, Paul? That's incredible.
I did hear that.
Paul, let's look up Merck real quick. Bogdan, a new user, requested this, and hopefully if he circles back, you'll be able to see this. Merck is a chemist company. What is this, Paul? Oh, wait, did I cut you off? Did you want to look at Walgreens, or did we already do that?
No, we already did that a long time ago, and I bought some Walgreens, so I think it's been fine. I think it's been good. So
all right, fire up Merck. Folks, I have a PhD in chemistry, so these chemical companies are near and dear to my heart. Go ahead, Paul.
All right, so Merck. Remember the big thing with pharmaceutical companies is their pipeline. I like Biogen. I have a lot of puts on Biogen. I have a few shares of Biogen. My base is about 242. So I'm sitting on a decent profit right now, but I do like Biogen, and Mo is a former med student. And he's like and my parents both like Mo, correct me if I'm wrong. Our parents both like Biogen, both our parents who are oncologists. So we do like Biogen, but Merck, $200 billion company. Let's call it 200 billion. 18 PE. So an X there, but not terrible. Nice profit margin expected with drug companies, 23.4%.
How about revenue growth? Pillar number 3, revenue growth.
Now you're going fast again, Seth. Why?
Sorry, I like to push you through. Keep going.
Don't push me through. $6.5 billion in dividends.
That's a nice dividend for a company nobody knows about. Keep going, guys. Keep going.
You don't know about. I don't know. I'm surprised you don't know about Merck. Okay, so 39.5, 39.8, 40, 42, 47. Now here's the interesting thing. It's a check mark. Pharmaceutical companies like acquisitions. This doesn't look like a lot of acquisitions have been made. Maybe they have been. I don't know, but they tend to like acquisitions. So either way, it's still a check mark. Net income, 4.4, 4, 2.4, 6.2, 9.8. Wow. Definite check mark there. Number of shares outstanding, 2.8, 2.56. Another check mark there.
Nice, Paul. How about current assets greater than current liabilities is pillar number 6, y'all.
Number 6, y'all. Let's see here.
Oh, Paul, wait. Before you do that, Paul, Corey asked an interesting question. How do you go about calculating fair value for a company that passes the 8 pillars? This is great, Corey. Thanks for asking.
So, Corey, it's a great question. If you ask 100 value investors what the fair value for the company is, what they call intrinsic value, you'll get 100 different answers. It all depends on how you look at the qualitative aspects of the business. You make your assumptions on growth. You make a range of your low end, your high end, kind of look in the middle and figure out what you think it's worth. And that's the problem. It's not like Mo and I could do a company and we come up with different numbers. We'd probably be somewhere near each other, but we have different numbers. So I'd love to be able to sit there and say it's this one exact number, but investing is an art and not just a science. The quantitative part doesn't tell the whole story. You got to understand the whole company, what it's doing, how it's going to get to it in the future. Is it going to grow? Is it not going to grow? And factor in those aspects when determining your value.
Let's get back to current assets greater than current liabilities, Paul, for what the hell?
26.6 billion in current assets, 20.4 in current liabilities. So they have 6 and change in extra cash lying around, which is good.
How about I'm ready. Free cash flow growth over the past 5 years.
Okay, ready? 11.3, 8.7, 4.6, 8.3, 10. So check mark for growth.
The average is 8.5.
Times 20. 16, what? 176 points, whatever.
171.6.
So close. Not there yet, but close. So it is a little expensive based on the free cash flow, a little expensive based on the PE. But if you think there's a lot of growth potential there, that could be justified in this. Nice dividend. I would still be waiting a little bit to buy it. It's already seeing like it's dropping down a little bit in the last year. It was at a peak of 92 down to 81. Down here, I definitely would have been buying. So where am I a buyer at? I don't know. Maybe Mo and I can do some research and look at this one and probably buy at. The thing is, guys, I'm a value investor. I want to buy at a massive discount to what I think the value is. So if I think the value is $70 here, I want to buy it like $40 or $50. I look for companies that are selling well below their actual value. So that's the big thing to understand here. Like I want to buy Merck much lower than this.
Paul, will you fire up momentum real quick? Guys, make sure you guys are obviously smashing the like button and subscribe if this is the first time you're here. We go live twice a week, Tuesdays and Thursdays at 1 p.m. Eastern, and we put out a video every single day to teach you more about investing, stocks, and all things like that. Paul, let's look at the momentum here for Merck.
So this is one to watch because the momentum just shifted. The 200-day just went below the 300-day back in July 7th. So what we want to do here is you want to keep checking the stock and watch it and send yourself a signal when the 200-day goes above the 300-day as a way to buy. So right now it has some negative momentum going, which is fine. You just have to wait for this to go above the 300-day. So that's where it's at right now. Last time it crossed over was in October of 18 at 71, and you would have sold at 78. You'd made a little bit of money. So you'd have bought at 71, it would have gone all the way to 92, and you'd given back profits all the way to 78. That's what this trading does. You lose out on, you don't get the high and the low, you get somewhere in the middle, but it's more consistent.
Paul, someone requested Teladoc Health, TDOC. Do you want to look at this?
TDOC. We get 11 more likes, guys. Come on, we need to get to 100 likes. This should be our goal all the time.
That'd be incredible, guys.
Okay, so market cap. There's no PE here. They lose money. Let's see how long they've been losing money for. Every year. They hate making money. I'm not going to look at it anymore. And here's why, guys. There are too many options out there. This is a growth story that I can't look at the quantitative part of it. You have to look at the qualitative. And I prefer to find the good quantitative story that gets validated with more qualitative aspects. So this one I'm just going to go ahead and ignore. It's losing money every single year since it went public. I'm just going to pass.
We have more Patreon requests. Phoenix, that's correct. Paul, I'd love to look at AutoZone. I have a product, side company, AutoZone. I sell go to dgfspray.com to see our product. It's a 70-year-old company I bought, and we're trying to get it into companies like AutoZone. It's near and dear to my heart. We have NASCAR teams on board. Boeing is one of our huge customers, and I'd love to see AutoZone, Paul.
AutoZone.
And this is off the request line from one of our patrons, Phoenix. Love you, Phoenix. Go ahead, Paul.
And we just got another patron. So we got 4 since this live stream started. I love it. Everybody should do that more and more. It is wonderful. So let me see one other thing here before we go further. All right. So anyhow, AutoZone. First off, personally, I like AutoZone. Like I like going there. They're very helpful. You go in there to buy something, they'll come do it for you in your car because if you're like me and just an idiot, you go in there and be like, hey, how do I put wipers on my car? And they're like, oh, we'll come out here and do it for you. Then they see me and they're like, you're a little prick. So I'm like, whatever.
Yes.
Anyhow, they're very helpful. So $27 billion company, 16 PE.
Gotta like that, Paul.
Not bad. Profit margin 16.3%. Another
Wow.
check mark.
Okay, we're doing great here.
Gross profit 53%. Now, this is a retailer. Retail is under a lot of scrutiny. I would want to understand, how is this company accounting for online sales? Do they have a lot of online sales going? Are they trying to partner with anybody to create more online sales? Or is it like other companies where the more and more people are still driving, and as they drive around, they do a pit stop and they stop there and get something? I don't know. You want to sit there and see, like, this is one of the qualitative aspects of the business you want to understand. Do people plan to go to AutoZone, or as they're passing it, they need something, they go stop in there and get it done? Or do they need an expert? Like if like me, I'm going to AutoZone. I'm not going to go to Amazon and buy something that I can't do. I'm going to go to AutoZone and say, guys, can you help me with this? I have no idea what I'm doing. This is a service-oriented. This is going to become more of service-oriented business, having knowledgeable people help you out.
Paul, does this profit margin surprise you? 16% as compared to just getting
retail.
Stuff and selling. Yeah, retail. This is great.
Yeah.
Okay, pillar number 3 is revenue growth over the past 5 years.
You know what I love, guys? Look at this. 10.6, 10.9, 11.2, 11.86, 12.63. Again, find out how many new stores they've opened in the last 5 years. See how same-store sales are doing, especially in this internet age with internet sales increasing. We want to understand that a lot. Let's see the last 12 months revenue. Wow, last 12 months revenue is still up. That's impressive. Yeah, I think we looked at this company once before, but let's keep looking.
Profit growth, pillar number 4, profit growth over the past 5 years.
1.24, 1.28, 1.34, 1.6, 1.7. So the internet's hurting them. Nobody told them. That's pretty solid, guys. And look at the last 10 years. Every single year, they made more money than the previous year. That's incredible. Look at that. Every single year for the last 10 years, they've made more money.
Good stuff. Let's do pillar number 5 is number of shares outstanding, Paul.
30 million down to 23.5. Check mark there. We have all check marks so far.
How about pillar number 6? Current assets greater than current liabilities. This has got my blood flowing. Who gave us this? Who requested this? Yeah, this is Phoenix again with AutoZone. Love you, Phoenix. Keep going, Paul.
Yeah, Phoenix is great. Same store sales increased. What? 21.8%? How's that even possible?
Wow.
Okay, Phoenix. Thank you. 6.8 billion. Down to 6.28. So barely a check. It is a check though, which is better than most retailers. Usually they have the negative there. So that's good. Now for my famous one.
Pillar number 7 is free cash flow growth. This is cash from operations minus capital expenditures, Paul. Pillar number 7.
So ready, Seth?
Oh gosh. Yes, I'm ready, babe. I'm gonna slam this now. This is awesome.
1.15, 1 billion, 1.5 billion, 1.6 billion.
Wow.
2.2 billion.
Wow.
Yeah.
Average is 1.5.
Yeah. This looks like a pretty good company, Phoenix. I kind of like this. I really do like it. Times 20, even times 15. Even times 15. It's pretty close. I mean, this is a pretty decent stock, guys. I mean, I think understanding the story here, understanding what they're doing, this is not bad. Oh, wow. Look at this company stock. Look at the stock price. I didn't even realize the stock price. Look at this. By the way, guys, I didn't even notice this. $1,160. It's a $27 billion company. It doesn't matter what the company price is. What matters is the market cap. And the other thing is they have no dividend yet. So this is something that might attract the future. I mean, I don't know. I kind of like this one.
Paul, people are saying in the chats, with the emergence of YouTube, which is only a decade old, the fact that people are now being able to go to AutoZone, look up something, work on their own car, they're seeing some growth in this. You know, I mean, I would agree.
Cars are going to change. I'm still think they're going to do a lot of stuff when it comes to electric EV vehicles, but EVs. But yeah, I don't mind this one. This one's pretty solid. I mean, what do they sell at? They sold under 750. They were at 728. I'd been a buyer all day at 728. This is a good company, guys. This looks pretty solid, Phoenix. I kind of like this. Thank you very much for sharing this. I think, Mo, I think we talked about this before, haven't we? Let's add this to our list, guys. 5 more likes. We need to get to 100. I just saw a bunch of people enter. If you have not hit the like button, I am going to kill you. You need to hit the like button. Free shirt for Phoenix. I think so.
we do need the merch, Paul. We got to get that merch table going, like a young band looking to grow. You know, when you go to concerts, they got the huge merch tables. I love that stuff.
Phoenix, what do you do? I want to understand what Phoenix does. He's been very astute. He has a lot of information. I kind of like.
I talked to him, Paul. He's looking. I think he's into construction management or something, and he's looking to grow into like being maybe like more diversified and being some sort of an investor. So yeah. Wow. Okay. Look. Marcio's joining us. Wow. We got 100. Boone Zodiac is great. Wow. 100 likes. Richard, I see you there. Man, this is incredible, Paul. The death threats worked, Paul. They totally worked, and that's great for you, Paul. Now we'll have to go back. Marcio said, let's do PVH and IN. What is PVH? You want to look that up real quick, Paul?
That's I know PVH. It's a home builder, I think. No, I was wrong. PVH designs and markets branded apparel in more than 40 countries.
PE of
Calvin
nothing,
Klein,
Paul.
What?
PE of nothing.
Yeah, they lose money. They lost $1 billion last year. Let's see if they always lose money. Or if it was just last year. Oh, in the last 12 months, they've lost money. Ooh, that's a big drop. The revenue's down a ton. Profit's down a ton. Let's see, are they down a lot? That's the thing that's interesting to me. They're not down a ton. Oh, yeah, they are right there. 160 to 81, down in half.
Let's look at this, Paul.
Okay, good. Okay, so X on PE, X on profit margin, solid gross profit though. Solid gross profit margin.
Okay, how about revenue growth over the past 5 years, Paul?
It's a $6 billion company. So revenue growth the last 5 years. It has a check mark, but if you include this year, it's down. So it is a check mark, 8 to 9.9. Profit is an X, 572 down to 417. Number of shares outstanding, 82.4 down to 74.2. So another check mark there.
That's nice. How about current assets greater than current liabilities, Paul?
Current assets, 3.8. Current liabilities, 2.5. So not bad there. They definitely have enough money on hand.
How about free cash flow, Paul? Free cash flow, pillar number 7.
Free cash flow last. Okay, so you ready, Seth?
Yeah, I'm ready.
All right. 640. 650, 290, 430, 650.
Is that a check mark, right? Growing?
I don't remember.
532 is the average, Paul, for free cash flow growth. 532.
It is growing barely, but it is growing. So 532 times $10 billion company. Guys, there might be some upside in this company. Once they get stabilized again, you're buying it for a value of 5.8. And once they get stabilized, making $400 million a year, that's selling for 11 times. I mean, this could be, if this is a play, guys, it's a long-term play that you're sitting there banking on them recovering and sales recovering on clothing because it's been hurt pretty bad. This is actually not a bad idea to look at. Or sell some puts on this thing. Are there any good puts on this that you can sell at much lower prices? Marcio just mentioned something about long-term resistance.
Yeah, interesting momentum.
Yeah, so this
Paul,
one might be a good. Yeah.
Let's close with this. EDUC is another offer Patreon request line. EDUC.
Well, we also got to our 100 likes, so I think I'm gonna go a little bit longer.
Okay, Paul.
18 more minutes.
Okay.
Educational Development Corp. Boy, look at the stock price. It was pennies for the longest time. And look at that. You see that right there?
What happened?
Can somebody tell us what happened here? It went from $3 to $25 and then fell back down. Publisher of the line of educational children's books produced in the United Kingdom.
Come on, what is this?
I know, I don't even get that.
Okay, what is the market cap? 131 million bucks.
Oh wow, this is so small. 14 PE check mark.
Okay.
Profit margin low, 7%. Not a check mark, but high gross margin.
Okay, yeah, look at that gross margin, incredible. How about
dividend 2.5%?
Very nice.
Which is about 3.2. I'll call it $3 million just to be conservative. I mean, just to be on the low side.
Revenue growth over the past 5 years, Paul, is pillar number 3.
86, 136, 150, 168, 160.
Nice. How about profit growth over the past 5 years, Paul?
Seems like they had a big jump in the last during the last year. Profit over the last 5 years, 2.1 to 5.6. So check mark there.
Very nice. How about number of shares outstanding, Paul? We want that going down, baby.
It's going up, 8.1 to 8.3. So up just a little bit, but it's up. It's still up.
Current assets greater than current liabilities is pillar number 6, Paul.
57.7, call it $58 million. And they have total liabilities of 50. So extra check marks there. They have more cash on hand than all liabilities. That's a very, very good thing. It's hard for companies to go under that have more cash and inventory on hand than they have liabilities. It's a very difficult thing. That is awesome.
Paul, we got a new patron, Swizz Deets. I love you. You're gonna, and then RJ Wolf says he wants to join later. That's incredible, guys. Swizz Deets, I can't wait to get to know you. Expect a message from both of us here very soon. Paul, let's look at free cash flow growth for this book company, this children's book company, Paul.
Okay, let me just see. Who was the person who asked? How do they do it? We're gonna join later. How do they do it? Oh yeah, RJ. There you go. Oh.
Yeah, guys, the Patreon page is just patreon.com/everythingmoney. It's in the description below, guys. If you want to click it, we'll get after it. Yeah. And
all
as
right,
always,
now free cash flow. You ready, Uncle
I'm
Seth?
I'm ready, Paul. Go ahead.
Oh boy. I'm gonna ignore year 5. So they only recently started making free cash flow. It's still expensive, but they have a lot of growth potential. I think the last year, though, they've done very well. Ooh, wow. What happened, guys? Something really big happened in the last year. Oh, wow. This is interesting. So somebody needs to understand what caused their cash flow and their revenue to look at their revenue, Seth.
Go on. Show me, highlight what you're talking about. Okay, look at this.
August of 2020, 81 million. August of 19, 35 million. They over doubled in 1 year.
Wow.
Is this sustainable? That's the question. Because look at the previous August, 35. They went down from August of 18 to August of 19. Why did this happen? They made $4 million in that one quarter. Why did that happen? So if you think that's sustainable, all day buy. If you think the company is hitting you plateau and it's fully sustainable, buy it. This is a great company to buy. Absolutely. The question is this sustainable? Why did they all of a sudden their revenues just double suddenly like that?
Paul, I'm going to look into that company. We should as well. I like the sound of that. That's pretty interesting. Thank you again, the patron Phoenix, for giving us that one. That was incredible. This was the Phoenix show today. One of our great patrons. Guys, I'm pooped. Paul, you must be pooped from talking for an hour and
yeah, I'll still talk though. You can go. I'll still talk though.
No, you want to keep going? No, let's keep going, baby. Let's keep going. Let's keep going. People are asking. This is great. This is a great question, Paul. Alex says, after becoming a patron, when do you get access to the Discord channel and connecting? So Alex, if you join, you will be thrown right in the fire of the daily discussions with our patrons who are very, very like-minded in what Paul is thinking, I assure you, with a more disciplined approach. I mean, basically...
And let me say something. Can I say something?
Go ahead, Paul.
There are 3 levels. The most active level is the $100 level. We have 3 times more messages than the other levels. Why? Trader Mo and I are active in it. We want to give those people the daily, because 2 people in that chat have already said, this is better than paying a financial advisor. I'm just going to listen to you guys. I'm just going to talk to you guys. And they're 100% right. So for $100 a month, you get a financial advisor. That's basically what it is. And you get to watch our thought process. Over time, you will learn so much about investing based on what we've learned. That's it. And when we get 25 people and they're all talking the same way, you're going to learn so much. So if you think $100 is a lot, it's not a lot in the grand scheme of things. But we're going to give our most attention to them because they're giving us the most. They're giving us the most money. That's just the way it is. Everybody's going to get the app. Everybody will get the app, all levels. If you just want the app, fine with that. If you just want the app and fireside chat every so often and like-minded people, do the $25 level. If you just want the app, do the $8 level. Everybody gets the app for free, no matter the price of the app.
And yes, Brody is right.
Yes, Brody is right.
Yes, we will be discussing acquisition of females in Paul and Trader Mo's life. Is that true, Paul?
Yes, and the other thing is we talk about everything in that chat. We do talk about my dating life, Mo's dating life, everything. We talk about everything in that. We don't even deviate from that.
Paul, this is someone requested this. This is Malik said, what is this company? 2U software company? You want to look at this?
Ticker symbol is what?
TWOU.
Education and training services, consumer defensive. Provides educational technology services for nonprofit colleges and universities. It builds, delivers, and monitors educational platforms that enable online delivery of degree programs. So from a long-term perspective, this I gotta think is a growth market. Seth, when we went to college, community colleges were a joke. Online schools weren't even around. And then when they did come out, they were a joke. Now it's completely different. I'm a big advocate of community colleges and online colleges. In fact, I believe all schools should be online. All colleges could be online. Save everybody a ton of money.
Yeah.
I'm actually bearish on big schools. I think they're going to have a harder time over time. Now, granted, they have football teams and there's a value to that, the whole experience. But for for-profit universities, I'm not opposed to them. This might be a good way to play on them. They make no money. They have not made money. Let's see how often they make money.
So what Paul's indicating is obviously the PE is nothing because they don't have any earnings, and the profit margin is...
They've lost money every year. I'm not going to look at this one because they've lost money every year. So from a valuation standpoint, even like cash flow, do they have cash flow? No, they don't even have cash flow. So I really can't value this at all. And I'm not going to go spend the time to go over the 10K and see what the potential is, blah, 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 blah. But that's that.
Akalai said Moot learning is the future, Paul. Do you want to fire up Moot and look at that? WMOOT?
I don't think that's a ticker symbol. I think that's something. What's MOOT? Ask Akalai. What is MOOT at Akalai? Well, I really love, it's so funny. As the time goes on, we get more and more people watching. Isn't that so funny?
Yeah, that's nice. Welcome, everyone. If you're just joining us, this is incredible. Yeah, Akalai, let us know.
We got another Patreon. Guys, we've gotten 6 patrons in this show. This is how popular stuff's going to be.
Oh, John corrected us. Paul, John said it's MOOC. I think he means MOOC. Let's see what that is.
No, I still have no ticker symbol for MOOC.
Okay, sorry guys, we'll work on that. Paul, let's look at, someone brought up, JWN, one of our patrons, Jordan from LA. Jordan, I love you. I love you. I love you. You know that, brother. This is Nordstrom. Paul, this is great. You love Nordstrom. Just do your spiel on Nordstrom. What do you love about this company?
So guys, I like Nordstrom. They don't have a ton of stores. I love the experience at Nordstrom. They're very big on customer service. I love Nordstrom Rack. The majority of the stores are Nordstrom Rack. I like buying. So the funny thing is, even with my money, I buy all my clothes on sale. I never buy clothes new. It's just a thing. I'm not new. I always buy them new. I don't buy them at full price. I love Nordstrom Rack. I have the app on my phone. It's super easy to buy, super easy to return. They do have a big footprint on retail, but at the same time, hopefully they can do the things where they have better products so people go to them as opposed to going to Amazon to buy their stuff. I mean, they have better things like that. I was a buyer of them. I bought them as low as $11, $12, as high, but they've gone from $12 to freaking $30 since, I mean, look at this. $11 on September 30th and $28 now. Did we get their shares taken away from us because of calls? It might have happened that way. Or maybe I did a $30 call. I don't remember. The whole point is I like Nordstrom. I do think they're a much higher stock price. I don't remember what I gave them as a value because of the recent downturn. If they get back to stabilized, let me see what their free cash flow is. Annual. That's the problem. They spent a lot of money on. Yeah. But I still think even at last year's number, it's still like 15 times free cash flow. Is this a risky play? 100%. You have to believe in retail. You got to believe that Nordstrom's going to do better. Because if you look at their revenue, their revenues are barely up over the last 5 years. I like Nordstrom from the perspective of their customer service. They do have a big footprint. I think I might have sold my let me see. I might have sold it because of the big run up so quickly. I'm not exactly sure, but either way, I'm a fan of Nordstrom as a company. There are definite headwinds there, though, guys. Definite headwinds. Don't get me wrong. But their online buying experience is incredible. I think something like 50% of their sales recently have been online. I mean, their online buying experience is very, very good. So
Paul, our dear patron Zach is wondering if you sold your Nordstrom yet.
That's what I'm looking up right now. Nordstrom. I did. I no longer own Nordstrom. So I took the run up and took my profits and said, let me go reassess.
Daniel said he's got to be a patron in order for y'all to notice me. Daniel, I do love you. Let's listen. Paul, we just got a patron. Daniel, I was going to skip you to look at Dropbox. Paul, we will finish with Dropbox after this, but because Daniel's been following us for an hour now, let's look at GPC. What is GPC, Paul?
Genuine Parts Company.
What is this?
That was automotive parts and industrial components.
What is that PE ratio, Paul? 2000.
Okay, like it. Let's see here. Financials. Let's look really quick. Well, the reason being is the last quarter they just had a massive plummet in income. What is going on here? Trailing 12 months, they've lost money. Last quarter. Okay, so let's take a look at this. X there on profit margin. They pay a 3% dividend. So with a company that's dropped so much, we want to make sure their dividend is sustainable. So it's going to be a big factor here. They're a $15 billion company. It spends about $450 million a year on their dividend. That's something to keep in mind. So XX so far. Revenue growth. Check mark. Big jumps here. Were there acquisitions? What's the deal? They had 9,200 stores. That might be hard. Who knows?
How about profit growth? Pillar number 4, Paul. Pillar number 4 is profit growth.
X. It's down over the last 5 years.
Mm-hmm.
Number of shares outstanding. Check mark. 152 to 145.
Current assets over current liabilities is pillar number 6.
7.4 versus 6. So check mark there.
Nice. How about free cash flow growth, Paul?
You ready? Now, this is for the last full year, ending last year. So it doesn't include 2020, which I'm sure was awful. So you ready,
okay,
Seth?
Go ahead.
1.05,
Mm-hmm.
780, 660.
780.
So 0.78, 1.05, 0.78, 0.66, 0.9,
Mm-hmm.
and 0.6.
Mm-hmm.
What's that?
It's 4 divided by 5 is 0.8.
0.8 times 20.
Mm-hmm.
It's selling for less. It's selling for less than the number, but this is parts, guys. This is automobile parts. The company sells over 9,800 stores worldwide, most of which are independently owned. So anything in retail, guys, it's specialty retail, which is good, but you want to, their gross profit's 35%. You want to understand what they're doing. Let's see their quarterly sales compared to last year. Oh, actually not that bad, not that far down.
Make sure you guys are smashing the like. We love you watching. It's incredible. Thanks, guys.
Massive loss in the second quarter, which in the second quarter of the year, which makes sense. This one's interesting. 3%. What was the average? Cash flow was 800 million, and their dividends 450. So the cash flow was decreasing, I think, wasn't it, or was it increasing? It was decreasing. So that's something to watch out for. The cash flow is down 30 or 40% in the last 5 years. So maybe you pay a multiple much lower. Maybe you got to buy it for like $10 billion as a company or something like that, because the cash flow is decreasing in an already hard market with a very big footprint. It's going to be very difficult to get out of that problem. So this is one I'd be cautious on. I'm not saying avoid it, but with retail, with the low profit margin, such a big footprint, and it being an automotive, it's kind of hard. Of course, there's no yes or no, just from the qualitative aspects have to be understood completely.
Paul, let's look for the final one. Our new patron, Warpin from Sweden, just asked about Dropbox. We've talked about Dropbox in the past, Paul. Let's look at it one more time.
Yeah, it's this one's going to be expensive.
Still, look at that price, Paul.
8.3 billion, 105 PE X, profit margin 7% X. Now keep in mind, Dropbox is trying to grow a lot, so this profit margin is going to be low as they spend more and more money on advertising. But still, 2 X's so far.
Pillar number 3 is revenue growth, Paul.
Revenue growth of the last 5 years. Okay, 603, 844, 1.1, 1.4, 1.66.
That's pretty good.
Yeah. So, and profit over the last few years, hate making money all day. Okay.
Well, their profit's going up, Paul.
Yeah, you're right. It's a check mark. You're right.
They're losing less money, so.
Okay. Number of shares outstanding, X. It's gone up.
Uh-oh. How about assets over liabilities? Current assets over current liabilities.
I am very much trying harder not to swear. 1.33 versus 1.02. So about $300 million more than they need, which is good. Free cash flow. Who's ready? They have free cash flow, though. I'm going to last for. What are you laughing about?
Look at Enrique. He just dropped 20 G's on Tesla. It's a tech company, Paul. You know that. It's a tech company. Remember 4 years ago when they were selling solar panels and then they just don't sell any of those either?
I think they sell solar panels still, don't they?
I'd love to have some, but I don't think that many. And the wall batteries, it's tough. But okay, Paul, let's keep going.
Their average free cash flow over the last 5 years, of the last 4 years, has been 300 million. They have a lot of growth potential. I'm seeing $6 billion as a value. Listen, I mean, it's overpriced, quote unquote. I wouldn't worry so much about you got to understand where their stabilization is. Like, how much of their free cash flow is being eaten up, the cash from operations, from growing. This actually might not be a bad deal. I thought this was going to be terrible. It might not be awful. You've got to understand how much of their expenses are advertising to grow versus stabilize, and what's their strategy long term. This actually might not be a terrible option on a company if you believe the growth is going to be very large. The question is, how big is their market? Can they become a $5-10 billion revenue company? They're at 1.8 right now, and their gross margin is insanely high. And if they're spending a lot of money growing on advertising, you've got to understand that by seeing what it would be stabilized. So they're always going to have advertising costs, but maybe they're aggressively spending money. They actually just turned a profit this year in the trailing 12 months. That's good. Let's see how many quarters of profit. Oh, man, look at that. 3 quarters in a row of profit. It's pretty solid, guys. They do that, $100 million. I mean, it's still a freaking high PE. 120 million, it's still a high PE, but the free cash flow number looks pretty solid. So maybe, I don't know why the PE and the free cash flow aren't lining up. That's the interesting part. Got to figure that out.
Paul, I think that's enough, baby. 90
That's
minutes
enough.
of you rocking.
And I want to thank all the people who've already signed up for Patreon. And we got another one that's 7 people signed up for our Patreon in this. That's a record in this during the live stream. I really appreciate it. We want to get 10 or 12 each live stream. That's going to be very beneficial for everybody. I'm telling you right now, you are dumb for not doing the Patreon. You get the app and the website for free just by doing the minimum level of $8. The app will be $15 or $25. I'm only going to open it up for the first 10,000 subscribers or some very low number. Well, as we grow bigger and bigger, it'll be the access to me. When we have 1 million subscribers and you're in the $100 group and there's only 25 or 50 of us and you can talk to me every day, you're going to really be happy you spent that money.
We go live Tuesdays and Thursdays at 1 o'clock. So get us in less than 48 hours from now. We'll be going live again. We'll get our topic in order tonight and tomorrow. As always, we want to thank our producer, Don. He's the one marking some of these comments and helping out. December 10th will be Paul and I and Trader Mo at Paul's, I almost said Paul's mansion. It's pretty much a mansion, Paul, but Paul's house, unrestricted, uncensored, lots of F-bombs, Paul and Seth, really diving into your questions. Last time we had 25 patrons and 15 people joined us on a Saturday night for this uncensored Paul and Seth show. It was incredible. You guys had like 6 hours notice, and we spent the Saturday night together talking about everything, including the women Paul's trying to track down. It's a different story. I've been married for 17 years, Paul, to my dear Beth, and you and Trader Mo were swiping left and right all day long, and we'll talk all about that.
That was fun, wasn't it?
That was fun. It's going to be even better, guys. So, yes, Llewellyn.
And by the way, and Beth, just like Lisa was doing for Mo, they spend too much time looking at every woman, trying to understand them. What's their personality like? It's swipe. It's cute, not cute. Cute, not cute. That's all we're doing here. And they're sitting there going like, well, she looks very nice. Oh my God, she has a puppy. Don't care. All I care about, are you hot or not? And then move on.
Paul, your take is always, it's great, Paul. Thanks everyone for just being awesome today. We will see you on Thursday, and a video comes out every single day. Thanks, guys. You're incredible. And Paul will go back to playing chess all day. We love you guys. Thanks so much. See you guys. See you, Paul. Love you.